Welcome to the final module of the course. So far, we've defined the reservoir, developed production forecasts, designed wells, and selected a development concept. Now we answer the question every investor, operator, and government ultimately asks: does this project create value? This module brings together everything from the previous modules and converts it into economics, investment decisions, execution plans, and ultimately end-of-life obligations. By the end of this module, you'll see field development planning as a complete lifecycle discipline, from first investment decision through to decommissioning. At its core, project economics is a cash flow model. CAPEX represents the upfront investment required for wells, facilities, and infrastructure. OPEX represents the ongoing cost of operating the asset throughout its life. Revenue comes from production volumes multiplied by commodity prices, adjusted for royalties, taxes, and fiscal terms. The difference between these elements creates cash flow. Notice how every input originates from earlier modules. The wells plan drives drilling CAPEX. The facility concept drives infrastructure CAPEX. The production forecast drives revenue. Economics is where all previous technical work converges into a single measure of value. And just like reserves and production forecasts, economics should never be represented by a single number. Every case should carry uncertainty through to the financial outcome. 3 economic measures appear repeatedly in investment decisions. The first is net present value, or NPV. NPV answers the question: how much value does this project create after considering the time value of money? The second is internal rate of return, or IRR. IRR measures investment efficiency and allows different projects to be compared on a consistent basis. The third is payback period. Payback measures how quickly invested capital is recovered. Each metric answers a different management question. NPV asks, how much value? IRR asks, how efficient? Payback asks, how quickly do we get our money back? A strong investment case typically performs well across all 3 measures, not just one. Not all barrels generate the same value to the investor. The fiscal regime determines how value is shared between the company and the host government. Under a concession system, the operator owns production and pays royalties and taxes to the state. Under a production sharing contract, or PSC, the state retains ownership of the resource. The contractor first recovers eligible costs and then shares remaining production with the host government according to the contract terms. A project can be technically identical but economically very different under these 2 regimes. This is why fiscal terms must be modeled explicitly. In field development planning, understanding the geology is important. Understanding who receives the value is equally important. One of the biggest mistakes in project economics is presenting a single deterministic result. Real projects contain uncertainty. Oil and gas prices fluctuate. CAPEX changes. Schedules slip. Reservoir performance differs from expectations. To understand these uncertainties, we use sensitivity analysis and probabilistic methods. Sensitivity analysis identifies which variables have the largest impact on project value. Monte Carlo simulation combines uncertainties across multiple variables to generate a range of possible outcomes. Another useful measure is break-even price, which indicates the commodity price required for the project to create value. Notice the recurring theme from this course. In Module 2, uncertainty was measured in barrels. In this module, uncertainty is measured in dollars. The principle remains the same. Estimate accuracy improves as project maturity increases. Early in project life, Class 5 estimates provide only an order of magnitude indication of cost. These estimates support opportunity screening and early concept evaluation. As engineering definition improves, estimates progress through Class 4 and Class 3. By the time the project reaches FID, management expects a Class 2 estimate that is sufficiently mature to support investment decisions. During execution, detailed engineering enables Class 1 estimates and tighter cost control. The important connection is that estimate accuracy should match project maturity. A project should never be asking for $1 billion investment decision using a Class 5 estimate. This is arguably the most important gate in the entire FDP process. FID is the point where planning ends and major capital commitment begins. A sanction-ready project requires 5 integrated elements: a credible subsurface understanding, a robust wells and production plan, a selected and de-risked development concept, a sanction-grade cost estimate, and economics that remain attractive across uncertainty ranges. Good organizations do not simply ask whether a project looks attractive. They ask whether the decision itself is based on sufficiently mature information. After FID, the cost of change rises dramatically. That is why decision quality is every bit as important as project value. Following FID, attention shifts from planning to delivery. FEED, or front-end engineering design, bridges the gap between concept selection and execution. The objective is to finalize technical scope, improve cost certainty, and establish the basis for contracting. Execution then includes detailed engineering, procurement, construction, drilling, commissioning, and startup activities. At this point, the greatest threat to value creation is uncontrolled change. Scope growth after FID remains one of the most common causes of cost overruns across the industry. The discipline established during select and define must now be protected throughout execution. Reaching first oil or first gas is a major milestone, but it is not the end of the FDP journey. Before production begins, commissioning verifies that facilities and wells perform as designed. The startup gate confirms operational readiness and safe introduction of hydrocarbons. Once production begins, actual performance is compared against forecasts developed in Modules 2 and 3. This is the industry's first real test of the assumptions made during planning. From this point forward, the reservoir management plan becomes the primary tool for guiding field performance and optimization. A common misconception is that decommissioning begins at the end of field life. In reality, it begins during planning. Every decision made during development influences future abandonment costs. Well count, facility type, subsea infrastructure, and platform design all affect future decommissioning obligations. Good projects treat decommissioning as a lifecycle cost rather than a distant problem. Financial provisions are typically established long before production ends. The key lesson is simple. A field is not truly complete until it has been decommissioned responsibly. Decommissioning requirements vary significantly around the world. The North Sea generally applies some of the strictest requirements, often requiring full removal of offshore infrastructure. The U.S. Gulf of Mexico incorporates alternative approaches in certain situations, including reef-related programs. Across Southeast Asia, decommissioning frameworks continue to evolve as offshore infrastructure reaches the end of its productive life. The important lesson is not the regulatory details themselves. It is understanding that decommissioning cost and obligation are highly dependent on jurisdiction and must always be evaluated within the local regulatory framework. The three figures on this slide summarize many of the core concepts from this module. The cash flow chart illustrates how investment occurs early while revenues are generated over many years. The tornado diagram demonstrates how project value responds to changes in key assumptions. The estimate accuracy chart shows how cost certainty improves as projects mature through the FEL process. Together, these visuals reinforce a central idea of field development planning. Uncertainty decreases with maturity, but investment commitments increase. The North Sea demonstrates why decommissioning must be considered throughout field life. Many assets developed several decades ago are now approaching abandonment. Operators face large costs associated with well plugging, facility removal, and infrastructure disposal. One important lesson from the basin is that decommissioning estimates often change substantially over time. As a result, responsible operators periodically update their decommissioning forecasts rather than relying on assumptions made decades earlier. The North Sea has become one of the industry's strongest examples of why whole-of-life planning matters. This case study brings together concepts from the entire course. Many Southeast Asian shelf fields are relatively small and only become economic through low-cost development strategies. Subsea tiebacks, standardized facilities, and shared infrastructure reduce capex and improve commercial viability. Under PSC fiscal terms, cost recovery mechanisms and profit-sharing formulas significantly influence project value. As a result, development concepts, well designs, fiscal terms, and economics become tightly linked. A technically viable field may still remain undeveloped if costs cannot be controlled. Ultimately, marginal field development is a demonstration of FDP at its most integrated. This slide captures the single most important lesson from the entire course. A successful FDP evaluates value across the complete field lifecycle. Capex is incurred at the beginning. Revenue is generated during production. OPEX continues throughout operations. Decommissioning costs occur at the end. Every early decision influences all later stages. Concept selection affects operating costs. Well count affects abandonment liabilities. Facility sizing affects production efficiency. There is no point in the asset life where early decisions stop mattering. This is why front-end loading is so powerful. The quality of decisions made before FID largely determines project performance for decades afterward. Let's summarize the final module. Economics converts technical plans into financial value. Fiscal regimes determine how that value is shared. Estimate maturity should track project maturity. FID is an integrated decision based on subsurface, wells, concept, cost, and economics. And decommissioning should be planned from the earliest stages of development, not treated as an afterthought. These principles complete the field development planning framework. As we close the course, remember that field development planning is ultimately an integration discipline. Subsurface defines the opportunity. Wells access the opportunity. Facilities enable production. Economics determines whether value is created. Throughout all 5 modules, one theme has remained constant. Uncertainty must be carried honestly through every decision. The best FDPs are not those that predict the future perfectly. They are the ones that make robust decisions despite uncertainty. And nowhere is that more important than offshore projects, where mistakes become very expensive, very quickly. Thank you.